Hopefully you did well recording the transactions from part A. This is now part B. Good luck on the quiz at the end of this part. Now we are to one of the hardest journal entries for students to learn, because there's actually two pieces of this transaction going on. There's what you gave and what you received. So what I want you to do whenever you have a transaction, when you're selling inventory to a customer and receiving payment or getting promised to receive payment, think of it as two different things. March 6th, we sold inventory costing $3,000. Let's just focus on that part. You gave away inventory costing $3,000. And when you give away inventory to bring about a sale, that's an expense. Your assets are flowing out in order to generate a sale, so we've got to record an expense. We have more of this expense. So as you can see, assets went down, and as this comes up, this debit will flow up and become a negative over here in equity. So assets will go down and equity will go down. That's the first part of this transaction. The second part is, what did we get in return? So we gave something up and incurred an expense, but what did we get in return? We got a promise to be paid $5,000. From prior videos, you would know that a promise to be paid is called an account receivable. So that's an asset. We have more of this promise to be paid, $5,000. And how did we get it? How did we finance this promise to be paid? Well, we financed it not because we borrowed the money, but because of running the business successfully. Therefore, equity for the owners will go up because we made a sale. We have more sales revenue. Let's put down the account names. So here on March 6th, we have more asset called account receivable. As you notice, we have more of it. How much more? $5,000. If we have more asset, that's going to be a debit. You can see I'm going through all four questions line by line. What's the matching part of this entry? We have more asset. Why? Because we made a sale. That is called sales revenue. We have more sales revenue, as you can see. When we have more sales revenue, as you can see, it's on the credit side, so we have to record it as a credit. As you can see, debits equal credits. That will make sure the balance sheet balances. Next, we have less inventory, so less asset and more expense. I like to put the debit side first, so I'm going to write that down. Cost of goods sold. We have more of that, so we need to say we have more of that. That's an increase of $3,000. When you increase an expense, as you can see, that's a debit. We decrease an asset. This asset is inventory because that's what we gave away. Decreased it, $3,000. When you decrease an asset, that will be a credit entry. I strongly recommend you study this entry because students really struggle with this. If you see how this winds up keeping the balance sheet in balance, your revenues and expenses will effectively increase net income by $2,000. These will be closed out. Those will become zero. And then net income gets closed in retained earnings, $2,000. And your equity will effectively be increased by $2,000 because capital, stock, and retained earnings added together will be equity. Over on the asset side, we have a net change. It went up by $5,000 and went down by $3,000. That's a net increase of $2,000. And equity, net increase of $2,000. So if you just kind of look at it from here above, it's in balance, isn't it? The net change, increase of $5,000 minus $3,000, $2,000, and it balances.